When Nancy Pelosi's portfolio disclosures drop, everyone goes one of two ways. Half the crowd screams insider trading, and the other half starts copying her trades. Today, we're doing neither. We're looking at the actual data, reverse engineering the investment logic, and pulling out what's genuinely useful for you. My name is Phoebe, and you're watching TradingKey. Pelosi's 838% versus Buffett's 230% returns. Let's start with the numbers. According to QuiverQuant, from 2014 to today, the Pelosi family's publicly disclosed portfolio has an 84.1% win rate, which works out to 58 wins and 9 losses, with a cumulative return of roughly 838%. Over the same period, the S&P 500 returned about 277%, and Warren Buffett's portfolio returned around 230%. So she's not just beating the market, she's lapping it. Two things explain this. The first is genuine fundamental analysis ability, largely shaped by her husband Paul, who has spent over 60 years in venture capital and commercial real estate in the Bay Area, giving them an unusually sharp read on where industries are heading. Their long-term Apple and Nvidia positions are the clearest evidence of that edge. The second is a policy sensitivity advantage that no Wall Street fund manager can realistically replicate. Before the CHIPS Act passed in 2022, she bought 20,000 Nvidia shares. In late 2020, she picked up Tesla just before the Biden administration's clean energy push sent the stock surging. And in June 2021, with markets panicking over antitrust legislation, she went the other direction and dropped $5 million into Google, and when the bill stalled, Google rallied. Whether you call that coincidence or not, the pattern is remarkably consistent. Nancy Pelosi's barbell strategy explained. Her 2026 first quarter positioning tells you one thing clearly. She thinks the market makes a big move in either direction, and she's not positioned for a flat year. What she's running is called a barbell strategy, where you put heavy weight on both ends with nothing in the middle. One side in ultra-defensive, cash-generating assets for downside protection, and the other side in high-growth positions swinging for outsized returns. On the defensive end, she opened a new position of 25,000 shares in AllianceBernstein, ticker AB, at an estimated cost of $1 to $5 million. It's a legacy asset manager that's not flashy, but highly defensive with consistent dividend cash flows. And notably, this is the first time in 12 years she's put over $1 million into a high dividend name, which is a signal worth paying attention to. On the growth end, she exercised options to acquire 5,000 shares of Vistra, ticker VST, at roughly $100,000 to $250,000, and another 5,000 shares of Tempus AI, ticker TEM, at around $50,000 to $100,000. Vistra is America's largest independent power producer, with nuclear as its core asset, and Tempus AI is an AI-driven precision medicine company using large language models for clinical pathology. We'll spend most of this video on Vistra because it's the most important position in the group. Alongside those 3 new stock positions, she also sold large chunks of her Apple, Nvidia, Amazon, and Google shares and replaced them with call options on the same names. Most people hear call options and think leverage or lottery tickets, but this is actually institutional risk management at work. If the stock surges, the option returns a higher percentage gain than holding shares outright. But if the stock crashes, your maximum loss is capped at the cost of the contract rather than the full value of the shares. The trade-off is that if the stock does nothing, the option underperforms. She hasn't changed which company she's exposed to, she's restructured how she holds the risk, and the implication is clear. She's given up the flat scenario entirely and is betting on a big move in either direction, which is consistent across the whole portfolio. But why make this shift right now? Is it geopolitical risk or skepticism about when AI revenue actually materializes? Let me know your theory in the comments below. Scarcest asset in the AI power demand. So why is Vistra the most important name in her portfolio? Because it has exactly what Pelosi's investment style requires. A hard, fundamental story backed by ambiguous policy catalysts where the outcome could be enormous. Vistra is an independent power producer whose capacity mix is roughly 60% natural gas, 20% coal, and 15% nuclear. And after acquiring Energy Harbor, its total nuclear capacity reached approximately 6,500 megawatts, making it the second largest nuclear operator in the U.S. It also sells directly to nearly 5 million homes and businesses through its retail brand TXU Energy. On the financials, 2025 adjusted EBITDA came in at $5.91 billion, and 2026 guidance is $6.8 to $7.6 billion, implying 15 to 29% growth, with a forward price-to-earnings ratio around 17.5 times at April 2026 prices. The natural gas business generates stable cash flow as the foundation, but the market is repricing the entire company based on one thing: its nuclear assets. Here's the structural case. U.S. electricity demand grew at essentially 0% per year for the past decade, and then AI happened. The International Energy Agency projects that by 2027, U.S. data center electricity consumption will exceed 300 terawatt hours annually, which is roughly 7 to 8% of total national demand. And Goldman Sachs estimates that between 2022 and 2030, the combined pull of AI, industrial reshoring, and broader electrification will push overall U.S. power demand growth to an annualized 2.4%, which sounds modest until you remember the baseline was essentially zero for the previous decade. Nuclear is the only technology that actually solves this for data centers. Wind and solar are weather dependent, and data centers need power around the clock. Battery storage is still mostly in the 4-hour range, so it helps at the margin, but can't carry baseload. Natural gas is stable, but carries hard carbon constraints that are increasingly a boardroom-level concern. Nuclear, on the other hand, runs at a 90 to 92% capacity factor with zero carbon emissions at the point of generation. And for tech companies that need guaranteed 24/7 baseload with a clean energy profile, nothing else comes close. Why Vistra's position is unbreakable. Building a new reactor in the U.S. takes 15 to 20 years minimum, requiring Nuclear Regulatory Commission approval, environmental reviews, community legal challenges, and upfront capital north of $10 billion, which means there is simply no new nuclear supply entering the market in the near term, and the existing operators are structurally protected. But there's another factor that takes the moat to another level. Tech companies are now building data centers directly next to nuclear plants to bypass the public grid queue entirely. And once that physical infrastructure is in place, switching to a different power supplier means reconnecting to the public grid, which requires years of regulatory approval and building enormously expensive new transmission lines from scratch. The switching cost becomes effectively infinite in practical terms, and that's a level of customer lock-in that very few businesses in any industry ever achieve. Now, the policy layer, and this is where it gets squarely into Pelosi territory. There are 3 variables, all genuinely ambiguous and all potentially massive for Vistra's earnings. The first is the EPA's cross-state air pollution rule, where strict enforcement would force aging coal and gas plants into early retirement, removing significant supply from the grid and pushing wholesale electricity prices higher. To put a number on it, Vistra's nuclear capacity at a 90% capacity factor produces roughly 50.8 million megawatt hours annually. So even a $10 per megawatt hour increase in average wholesale prices generates approximately $508 million in additional profit, nearly 7% of total earnings from one modest regulatory nudge. The second is the Federal Energy Regulatory Commission's review of direct data center to nuclear plant connections, where a green light allows Vistra to lock in 20-year power purchase agreements with major tech companies at high fixed margins. But if it's blocked, those customers go back to the public grid queue, and the revenue timeline gets pushed out significantly. The third is the ERCOT wholesale price cap in Texas, which currently sits at $5,000 per megawatt hour in a fully deregulated market. And if extreme summer heat collides with AI-driven demand this year, there'll be political pressure to lower it. But if the cap holds, Vistra captures peak pricing in full. Understanding Nancy Pelosi's strategy. Pelosi's Q1 2026 portfolio isn't complicated once you map it out. She's hedged for volatility on both sides, loaded the growth end with nuclear power and AI-driven healthcare, and restructured her tech exposure through options to limit downside while preserving upside. The Vistra position specifically sits at the intersection of ironclad supply constraints, accelerating power demand, and three policy outcomes that could each independently move the stock in a significant way. In this AI cycle, the obvious trade is still semiconductors, but the structural opportunity with real barriers to entry is the physical infrastructure that AI simply cannot function without, and that's exactly where Pelosi is putting her money. So, what do you think? Do you agree with her portfolio play? Let me know your thoughts in the comments. Thanks for joining me today. If you found this video helpful, remember to subscribe to TradingKey, give this video a like, and share it with a friend who might just benefit from learning this too. With that, I'll see you in the next one.